Good evening, everyone. Today we are going to continue from where we stopped in our last class under the topic of capital budgeting. So far, so good. Uh, we have discussed all the relevant principle underlying capital budgeting. And last week, we started the calculation and we did only one illustration to that matter. And today, like I promised you, uh, we are going to have calculation all throughout. The beauty of capital budgeting is that once you understand the underlying principle and you know the relevant formats you are supposed to use where necessary, not only that, if you are able to memorize all the relevant formulas, then that means you are good to go. However, examiner trick the question. However, examiner turn upside down the question. No matter how big is the scenario, principle is the same. It doesn't change. So what that means is that if you apply the right principle, certainly you are going to get to the right answer. And that's why I will encourage you to do your best, go through all the notes. At this stage, I will expect that since you have access to the video, as you are listening to the video, you'll be jotting down. If at all you have not been jotting down during the normal class. So when you are listening to the video at your own comfort, at your own convenience, so you are supposed to be jotting down, forming your own notes, all right? For you to be able to have deep understanding of each of the topic that we have treated so far, because time and time wait for nobody. Poco a poco, we are getting to the D-Day. You know, last week, ICANN published the exam dates for May 2024 diets. Okay, so what that means is that it is expected as students that you should motivate yourself by that communication. You should motivate yourself by going ahead. If you have not been reading previously, you need to change your attitude towards your studying because, like I said, time and childhood for nobody. Your exam is May 14th through 16th. So if by end of April, you have not covered substantially the scope of the syllabus, then that means you are going to struggle because few days to the exam may not be sufficient for you to do justice to the exam that that you want to write. And that's why it is important for you to take it very seriously because the way things are right now, this is the best time for you to acquire all the relevant certification, you know, by taking them once you register for a particular certification, take it very seriously and make sure you pass so that you can get value for all the sacrifices that you have made, you know. You don't I don't like it when I see my old students, you know, repeating a class. It's not our wish. It's not something that we want to experience. And that's why it is important for you to take this exam that you want to write very seriously. You study as if everything depends on the exam. You know, it's almost in November 2020, effective November 2021, I can change syllabus to what we are currently using. And every 2 years, according to them, that they are going to be changing the syllabus. So hopefully by November 2024, a new syllabus may come out. So what that means is once there's a new syllabus that will be changed in the exam structure. So and that's why it is important for you do whatever you need to do now and ensure that you pass your exam. Okay, once you pass this, your main diets, no matter how I can change the syllabus going forward, you are less concerned with that. You have already qualified. And that's why we are encouraging you to put your best. At this stage and at this moment, I expect that all of you would have designed your reading timetable. And once you design your reading timetable Monday to Sunday, however you want to do it, no matter how tight are your schedules, you have to just have to design that your reading timetable and be committed to it. It is one thing for you to have a very lofty okay, juicy kind of timetable, reading timetable is another thing for you to be committed to it. You know, if you say you are going to be reading strategic financial management, for example, on Monday, okay, are you reading it on that Monday? Okay, so if you say on Tuesday you want to be reading advanced audits, as you have scheduled it, are you reading it? So this is what we are saying. So please take it very seriously, and I pray that God Almighty will make it very easy for you. So today, uh, like I said, it's just about calculation till we are going to complete. Once I'm done with different scenario questions that we are going to test in this class, then we can then move to the next topic. Okay, so let me see some questions, illustrations we have here, and see which one we are going to start with today. We have solved illustration number 2. We have not solved this illustration number 1. Have we solved illustration number 1 through talk? Please check. Have we? I doubt. In any case, but I'm very sure of this illustration number 2. We have solved that. So we have also solved this illustration number 3. That's what I used as an example when I was taking you a modified internal rate of return. Okay. Then this illustration number 4, we have not solved this. Ferrari. Let me see the requirements. Okay. The requirement is about A is cost of capital, then B is NPV. Then illustration number 5. Illustration of this now this is the latest question tested under capital budgeting for compulsory question tested. So in November 2021, it was internal rate of return mainly. Okay, we are coming back to that. I'm looking for a question that involves modify internal rate of return, then NPV. Which one is this? Number A of this one is cost of capital. Then yes, let's start with this. Let's start with this illustration. Okay. Let's start with this illustration. Let me look at some of you that are okay. Shina, you are welcome. You came late. Abu, you also came late. Mohammed, Abdullah, you came late. So one of you that came late will be the one to read the question. Shina, please read.
Okay, sir. Telemundo PLC is a company listed on Nigerian Stock Exchange. It is involved in property development and sales. The company currently imports more than 60% of its cement requirements. At a recent meeting of the board of directors, decision was taken to establish a division for the production of cement in Ore, Ondo State. If the division is set up and the cement production goes up, output from the division will be sold to Telemundo PLC and external customers at market price. For planning purposes, it has been decided that the financial viability of the project over the next 5 years should be determined. The sum of 2 billion naira will be required. The sum of 500 million naira will be spent to acquire an existing factory considered suitable for the project. The balance of 1.5 billion will be applied for the procurement and installation of essential plants and equipment. Tax allowances can be claimed on plants and equipment at a uniform amount over 5 years with nil scrap value. A total of 20 million naira has been spent on various surveys, markets, technical, financial, etc. to date, out of which 10 million has been paid. The balance of 10 million naira is due for payment at the end of year 1. These are the the production of cement for the next 5 years is projected as follows. Year one, 500,000 bags. Year two, 600,000 bags. Year three, 650 bags. 650,000 bags. Year four, 800,000 bags. Year five, 700,000 bags. A bag of cement currently sells for 2,000 naira in the open market. This price is expected to increase at the rate of 5% per annum. Variable cost is now 800 naira per bag. This will increase at 4% per annum. Fixed overhead cost will be 50 million naira at current prices, but will rise by 8% per annum. Apportion head charges of 25 million naira at current prices will increase by 10% per annum. 50% of the total initial outlay of 2 billion naira is to be funded with a loan from a federal government development bank at a conventional fixed interest rate of 8%, payable at the end of year five. The project will require a working capital of 10% of annual revenue, and this should be available at the beginning of each year. The company uses a current weighted average cost of capital of 11% to appraise all capital projects. The asset beta of the company is 1.2, equity beta is 1.6, risk-free rate is 5%, while the market risk premium is 7%. The finance director is of the view that it is not appropriate to use the existing weighted average cost of capital to appraise the new project. He has identified a listed company which currently produces cement and packaged fruit drinks. The company has the following financial statistics. Equity beta 1.82, debt 0.4, debt to equity ratio 40%. 60% of the market value of the company is attributed to cement production, while 40% of the value is attributed to the fruit drinks division. The fruit drink division has equity beta of 0.8. The new project is expected to move Telemundo PLC to the target debt to equity ratio of 30%. The tax rate is 25% for the two companies and is paid in the year profit is made. We are all required to compute the appropriate cost of capital that Telemundo PLC should use to appraise the cement project and state why we should consider this rate more appropriate than the existing WACC of 10%. Please note that the final cost of capital should be rounded up to the nearest whole number. State any assumptions made. Why number 2 question is compute the net present value and the modified internal rate of return of the project, which is the MIR, assuming a cost of capital of 13%, up to the nearest million. Number C, recommend whether the project should be accepted or not using both NPV and MRR methods.
Thank you very much, Shina. This is the question. The reason why we have to choose this question as one of, please mute. So the reason why we choose this question as one of illustrations is because of the fact that you are asked to compute NPV as well as the modified internal rate of return. If I like, I can also add another requirement to that, maybe project duration. But the usually is that when we had cost of capital, I also mentioned to you that when we get to capital budgeting, we are going to have illustration that involve calculating project-specific cost of capital. So that's one of the reasons why we have to solve this illustration. But I know we're standing without wasting more time. Let's go straight to the question. Now, first thing first, whenever you are given a question, always start from the requirements, okay? Because the requirement will prepare your mind on the expectation of the examiner. So if that is the case, in this requirement number A, you have to compute the appropriate cost of capital that Telemundo PLC should use to appraise the cement project and why you consider this rate more appropriate than the existing WACC of 11%. Examiner is asking you to calculate appropriate cost of capital. So at this point, you need to ask yourself, what kind of cost of capital do you want to calculate? Okay. What kind of cost of capital? Is it project specific cost of capital? Is it traditional cost of capital? So all of this you need to know before you put your pen to paper. Very, very important. Before you put your pen to paper, you must know the kind of cost of capital that you want to calculate. So if that is the case, from this requirement, we don't know the kind of cost of capital we want to calculate until you go to the question and read the scenario. All right. So that I mentioned to you, there are three ways in which you can calculate cost of capital. When you say cost of capital, what we simply mean is the weighted average cost of capital, the WACC. So, when we had the discussion or the class under cost of capital, I said that there are three ways in which you can calculate your WACC. You can either use traditional WACC, you can either calculate project-specific WACC, or you calculate WACOCA. So, and I said that if in the question, you are given capital structural information, you have ordinary share capital, you are given debt capital, you are given preference share, you are also given the return of each source of finance. It means that you are supposed to calculate your WACC using traditional method. Then I also said, when we get to project specific, I mentioned to you that project specific cost of capital is calculated when a company is diversifying or when debt equity proportion are expected to change significantly as a result of undertaking a project. So, and then the third one, which is WACOCA, weighted average cost of capital of the combined activity. I said WACOCA is calculated when a company is engaged in several business activities at the same time, that's when you calculate your WACOCA. So I will then go back to this question. I begin to read. Once I've read the requirement of the question, examiner is asking me to calculate the appropriate cost of capital. So I need to read A to Z of the question to see what the question is telling me, the scenario that the examiner has painted. So once I can see any clue that relates to diversification, when I can see that the company is diversifying into a new industry, it means that I need to calculate project-specific cost of capital. In this question, I don't have capital structural information because I'm not given ordinary share capital. I don't have dividend. I don't have interest expense. So I cannot use traditional method to calculate my cost of capital. So I will then read from the first paragraph. Once I can identify from the question that the company is diversifying, I don't need to read from the body again. I will just go ahead straight to where I have the information of the proxy company. So we are told that Telemundo PLC is a company listed on the Nigeria Stock Exchange. The company is involved in property development and sales. The object clause of this company is property development and sales, nothing more. The company currently imports more than 60% of its cement requirements. So when the company wants to develop projects, okay, build houses, so they usually import 60% of their cement requirements from abroad. So at a recent meeting of the board of directors, decision was made to establish a division for the production of cement in Ondo State. So this company is planning to establish a division for the production of cement in Ore. This company is not into production of cement, but now the company wants to start producing cement to be established in Ore. So what that means is that Telemundo PLC is diversifying because the company is not into cement, but now the company wants to be doing cement. So the company is diversifying. If the division is set up, the cement production the division is set up and the cement production goes ahead, output from the division will be sold to Telemundo PLC. an external customer at the market price. For planning purposes, it has been decided that the financial viability of the project over the next 5 years should be determined. So I'm less concerned with all of this information. I'm looking for the information that shows to me that the company is diversifying. Now that I have the information, I can then go ahead and begin to solve. Okay, so the next thing, now that I know that the company is diversifying, the next thing I will do, the next step I will do is for me to go ahead through the question to see where I have information of a proxy company. When I see a company that is different from Telemundo, when I can see a name of a company that is different from Telemundo, then it means that that company is the proxy company. But in this question, we are not given information, we are not given the name of a proxy company. We're only told that when you look at the paragraph before the financial statistics, you will see that we are told that if you look at this paragraph, we are told that the finance director is of the view that it is not appropriate to use the existing WACC to appraise the new project, which is correct. He has identified a listed company. So as I'm reading, I will just underline a listed company, which currently produces cement and packaged food drinks. So this listed company represents the proxy company that we are looking for. And this proxy company produces is into two businesses. One is cement, the other one is food drinks. So the listed company, the proxy company produces cement and packaged food drinks. So if that is the case, I have found the proxy company. So at this point, what am I supposed to do? Very simple. I told you, whenever you want to calculate project-specific cost of capital, there are 5 procedures. The first procedure is to identify the proxy beta. Then 2 is to ungear the beta if the beta identified in step 1 is geared. Then step 3, you re-gear in order to incorporate financial risk of Telemundo in this case. Then step 4, you calculate cost of equity of Telemundo, which is using capping. Then lastly, you calculate the project specific cost of capital. That's all. Those are the 5 procedures you need to, no matter how big is the question, it's the same procedure. All right, just go into the question, get the relevant variables that you're looking for, then begin to solve one after the other. So in this case, remember, Telemundo PLC is diversifying into cement production. Therefore, I need beta of cement industry because the risk associated with each industry differ. The risk in cement is different from the risk in food drinks, packaged food drinks. All right. So it's also different from the risk in the development on the what's it called? Property development. So the risk in property development industry is different from the risk in the cement industry. It's also different from the risk in packaged food drinks. So if that is the case, let's quickly solve this question and move on. All right, to the next one. Let me stop sharing this and move to the working notes quickly. Okay. All right. Let me know if you can see my screen. Can you? Can you see my screen?
Yes, yes, sir.
Yes, sir, we can.
All right then. Thank you. Then mute yourself, please. So the name of this company is Telemundo. Before that, I will say solution. So illustration, what is, are we solving? That's illustration number 10. Thank you. Illustration number 10. Okay. Then Telemundo PLC. In the first requirement, number A requirements, examiner is asking you to calculate, you have to compute appropriate cost of capital. So I would then say calculating cost of capital. So we have identified from the question that we are calculating project-specific cost of capital. So if you call it project-specific, if you say calculating project-specific cost of capital, no issue. All right. So remember, if I were you on the day of the exam when I'm writing, if you like, you can simply say the code that I gave to you. You identify the proxy beta of cement, you ungear the beta, you regear, okay? You calculate capping, then you calculate WAP. So these are the 5 procedures. So this will guide you. So the first thing we want to do now, the P, letter P represents proxy beta of cement. I would then say proxy beta of cement. Okay, let's go to the question and identify that. That's our step 1. So according to the question, let me see, please open to the question. You have it, you have the material. So according to the question, we are told that the company has the following financial statistics: equity beta of 1.82. So I'm looking for beta of cement. I'm looking for beta of cement. This process company produces both cement and packaged food drinks. An examiner has given us equity beta of 1.82. That 1.82 is meant for cement and packaged food drinks, okay? But I'm looking for equity beta of cement alone. So, so far, when you look at the question, another information I have that relates to equity beta is 0.8. We are told that the food drinks division has equity beta of 0.8. So examiner has given me equity beta of the combined businesses. I'm also given equity beta of food drinks. So I'm not given equity beta of cement. I don't have equity beta of cement. Therefore, I will say unknown. I don't know this yet. Unknown. So if that is the case, if you are not given the equity beta of cement, then you need to use the information that you have to get what you are looking for. So if that is the case, according to this question, I'm given combined equity beta. I have combined equity beta of 1.82. This 1.82 is meant for cement and food drinks. So I cannot use it for cement only. I can also use it for food drinks. So because it is meant for the 2 of them. Not only that, I'm also given equity beta. Examiner gave us equity beta of fruit drink. In short, let's call it fruits. So we're also given equity beta of food drinks, which is 0.8. Not only that, according to the question, we're also given debt beta of 0.4, the debt equity ratio of the proxy company of 0.4. So debts, we have debt beta of 0.4. Then examiner also gave us debt equity ratio, debt equity ratio. That is the gearing ratio, debt equity proportion to be equal to 40%. Let me confirm that. Yes, 40%. So this means that debt is 40%. So if D is 40%, then it means that equity will be 60%. Here is 40%, then equity will be equal to 60%, 0.6. So let's move on. We can have additional information of the proxy given. Then we are told that 60% of the market value of the company is attributed to cement production. So we are given market value. So market value of cement to be 60%. You can if you like, you can say 0.60 is the same thing. The market value of fruit drink, we are told is 40%, 0.40. What other information of a proxy are we given in the question? That's it. Then we need the tax of a proxy company. Okay. So we are now told that tax rate is 25% for the two companies and is paid in the year profit is made. So what this means is that both Telemundo PLC and the proxy company have the same tax rate of 25%. So without wasting more time, I can then come here tax rates equal to 25%. Okay? So if that is the case, like I said, the beta of cement, the equity beta of cement is not given, it's unknown. Okay? But this information are given for the, okay, let me just put this, let me do it this way. Let me rewrite this. The equity beta of cement is not given. Is not given. However, the following information given can be used to determine the following information given can be used to determine the equity beta of cement. Okay, I don't have space again, so let's manage like that. Then move on. So if these are the data given to us for the proxy company. So, and this is what we are going to use to get the proxy beta of cement. So if that is the case, remember when we had WACOCA, weighted average cost of capital of the combined activities, we use a formula to get the combined asset beta. That formula that we use to get the combined asset beta is what we are going to use to get the value that we are looking for. Okay? Or I can also rewrite this. So that's, okay, let me just leave it like that. Therefore, the equity beta of cement will be calculated using the formula below. So when we had weighted average cost of capital of the combined activity, we said that combined equity beta, as in this case, is calculated as beta equity of cement multiplied by total market value of cement divided by total market value of cement and fruit drink. Keep this one on one side, plus, open a bracket, beta equity of fruits multiplied by total market value of equity and debt of fruits divided by total market value of cement as well as the fruit drink. All right. So you remember this formula that we used when we calculated, when we had WACOCA. Okay. So because we are given combined equity beta of 1.82, so and that's why we're able to determine that, okay, since we are given a combined equity beta, we should be able to use this formula. The formula that I can use to solve the question is different from this one. I can solve the question using unknown to get the known variable. Okay, I mean using the known variable to get the unknown variable. But again, since we have a formula we can use, why can't we use it? And that's why this one is more straightforward. Therefore, I would then say, since combined equity beta is 1.82, okay, remember, our combined equity beta here is 1.82. Then, beta equity of cement. The beta equity of cement is unknown, is what we are looking for. Okay, that's what we are looking for. Multiply by total market value of cement, we got 60%. Examiner gave us 60%. Market value of cement, 60%, 0.6. So I would then say, instead of me to say 60 over 100, I can just put 0.6 here. It's the same thing. 60 over 100 is equal to 0.6. So the total market value of cement and food drinks is the 100%. Total market value of cement is the 60%. So then plus, open a bracket, beta equity of food drinks, okay, which is 40%, no, 0.8. Here is equity beta of fruits is 0.8. So let's go and put it there. This one is 0.8 multiplied by total market value of fruits is 40%, 0.4. So at this point, I would then say 1.82 equal to 0.60 BEC, beta equity of cement, plus 0.32. Then I will collect like terms. 0.60 BEC equal to 1.82 minus 0.32. Therefore, beta equity of cement equal to, bring out your calculator, let's go through it together. So 1.82 minus 0.32, that's 1.5.
Okay,
Therefore,
1.5.
thank you, 1.5, then divide by 0.60 equal, divide by 0.6 equal 2.5. So beta equity of cement production is equal to 2.5. Now that we have found the beta equity of cement, then we can then go ahead to step 2. Step 2 says we should ungear. U means ungear. So you only ungear if the beta you have identified in step 1 is geared. So this beta equity of cement of 2.5, is it geared or ungeared? And I explained to you when we have project-specific cost of capital, the beta equity will be geared if and only if the proxy company is a gear company. The proxy company will be a gear company if the company has debt in its capital structure. Can we see debt in the capital structure of this proxy company? Yes, that's what the examiner has given you, the debt equity proportion of 40%. So it means that there's debt in the capital structure of this proxy company. So what that means is that the 2.5 equity beta of cement is geared. Therefore, we need to ungear it. So step number 2, ungear. You only ungear to remove financial risk. Financial risk of the proxy company. Okay. So if that is the case, I need to ask now that I want to ungear, which formula am I going to use to ungear? All right. I gave you two different formulas to ungear. I said that if debt beta is assumed to be risk-free, then you are going to use the smaller formula. But if you are given debt beta, then you are going to use the extended formula. In this question, we have examiner has given to us debt beta of 0.4. We have a debt beta of 0.4. So it means that we are going to use the extended formula to ungear. So if that is the case, I would then say, using the extended formula, beta assets, which is ungear beta assets equal to beta equity gear multiplied by equity value divided by equity value plus debt value 1 minus tax. So if had it been the proxy company does not have debt, had it been we are not given debt beta, this is the formula we would have used. But now that we have a debt beta, then I need to add to this. I would then say plus debt beta multiplied by debt value multiplied by 1 minus tax divided by equity value plus debt value 1 minus tax of the proxy company. Okay, so this is the big formula that we are going to use to calculate our beta assets. So if that is the case, I would then say beta assets equal to beta equity gear. We got beta equity gear of 2.5. Here will be 2.5 multiplied by equity value of the proxy company. Okay, examiner has told us I need equity value of the proxy company. So examiner has told us that the debt equity ratio of the proxy company is 40%. Debt is 40%, equity is 60%. So since examiner did not tell me how I'm going to determine the structure of my gearing ratio, okay, whether I should use total value method, so or whether I should use just debt over equity. So examiner is silent, therefore I'm at liberty to use anyone that is more convenient for me. Therefore, I will just say my gearing ratio is equal to debt over equity. But if in the question examiner define the gearing ratio, at times examiner can say the gearing ratio equal debt over total value. Total value means debt plus equity. That is the denominator. If examiner define it to, if I want to calculate my gearing ratio, just for explanation purpose, if I want to calculate my gearing ratio, I can say gearing equal to debt divided by equity. Okay, this is one way of calculating gearing. If I don't want to use this, I can say gearing ratio equal to debt plus equity plus debt, or debt plus equity. Debt plus equity. If I do this, that means I'm using total as my denominator. If I use it, that means I'm using only equity as my denominator. So whichever, but in this question, examiner is silent. I'm not told. Examiner did not tell us how our gearing, we are just given gearing ratio of 0.4. So I'm at liberty to either use this or I use this. All right. So if that is the case, I will then go back to my solution. My equity, if debt is 40%, it means that equity will be equal to 60%. Now, in this case, if I want to, I can say debt equity ratio equal to 0.4 to 0.60. If I want to use total as my denominator, since debt is equal to 40, debt is equal to 40, I'll just say 0.4 to 0.42, then 40 plus 60, that's 100. So 0.4 to 1, okay? 0.4 to 1, this is what I will use. But since examiner did not define it, so use the one that is more convenient for you. Therefore, I would then say, since debt is 40% in this one, then equity will be 60. So that's 60 divided by, anywhere you see E, you put 60. Debt is 40. Tax rate is 25%. That means we are supposed to account for 75%, 0.75. Okay, I'm done with that side. Move to the right side. The debt beta is 0.4. Examiner has given our debt beta to be 0.4. Here is it, 0.4. So if that is the case, I will then come here. 0.4 multiplied by debt value is 40%. Tax rate is 25%. We are accounting for 75. So divide by equity. Sorry, this is 40. So 40, 60 plus 40, 0.75. Let me delete these ones. Okay, so if that is the case, I bring out my calculator. Let's solve it together, please. So I would then say 0.75 plus 40 equal, sorry, what am I saying? 0.75 multiplied by 40 equal 30, then plus 60, 90. Therefore, 60 divided by 90 equal multiplied by 2.5 equal, that's 1.67. My BA, beta asset equal to 1.67 plus the other side, 30 over 90, 30 divided by 90 equal, multiply by 0.4 equal 1.3, 0.13. So when I add the two together, my beta asset will then be equal to 1.80. So I'm done with beta assets. This is on gear beta. I will then move to step 3. Step 3 says we should regear R. Remember the acronyms. R means I should regear. In order to incorporate financial risk, I will say regear. To incorporate financial risk of Telemundo PLC. Therefore, so remember what I told you when I was explaining cost of capital project specific. I said from step 1 and step 2, you need the information of the proxy company. So from step 3 to step 5, you need the information of the main company. The main company is Telemundo. So I don't need the information of the proxy company again. Therefore, so for me to regain, I need to ask myself, what kind of formula am I going to use? I also gave you 2 formulas that you can use, okay? Where there is debt beta of the main company. So you are going to use the extended formula. Where there is no debt, where debt beta is risk-free, you use the smaller formula. In this question, I need to go back to the question, am I given debt beta of Telemundo? So based on what we have read so far, there is no debt beta of Telemundo. It means that the debt beta of Telemundo is risk-free. Okay, it's risk-free, is 0. So if that is the case, then I will then come here. I'm not given debt beta of Telemundo. I can just come here and say, my beta equity of a gear will then be equal to beta assets multiplied by 1. Let me write that. Okay, let me just leave it. 1 plus 1 minus tax, debt equity multiplied by debt equity proportion of Telemundo. Okay, so I only use this formula because debt beta of Telemundo is now given. So I will then say, let me just put it for you. Since debt beta of Telemundo is not given, the formula below will be used to calculate the beta equity of a gear. All right. Okay. A gear. BEG. All right then. So if that is the case, I would then say beta equity of a gear equal to beta assets multiplied by 1 plus 1 minus tax, debt equity proportion of Telemundo. Therefore, the beta equity of a gear will then be equal to, we got beta assets. The beta asset we got in step 2 is 1.8. I would then say 1.80 multiplied by 1 plus. We are told that both the two companies, that is Telemundo as well as the proxy company, have the same tax rate, and the tax rate is 25%. So 1 minus 25% will give me 75%. So we are accounting for 75%. So debt equity proportion of Telemundo. Let's go back to the question. I told that in the last paragraph, the new project is expected to move Telemundo PLC to the target debt equity ratio of 30%. So if debt is 30%, equity will be 70%. Therefore, this one will be 30 divided by 70. So what do you then get? So bring out your calculator. I will say 30 divided by 70 equal multiply by 0.75 equal plus 1 equal multiply by 1.8 equal 2.38. So beta equity of a gear is 2.38. Okay. Remember, your gear beta must always higher than your asset beta. If asset beta is 1.8, then you should know that your gear beta must be higher than that. So I will then move to step 4. Step 4 says I should calculate cost of equity, which is capping. So calculating cost of equity using capital asset pricing model, KE. So my KE equal to risk-free rate of return plus beta multiplied by market return minus the risk-free rate of return. So KE equal. I will then go back to the question. What is the risk-free rate of return? Let's go and identify risk-free rate of return. So the paragraph before the proxy information, that's where you have this information. We are told that the company uses a current weighted average cost of capital of 11% to appraise all projects. The asset beta of the company is 1.2, equity beta is 1.6, risk rate is 5%, while the market risk premium is 7%. So risk-free rate of return is 5%. That's what we are looking for. So I would then say 5 plus the beta we have calculated is 2.28. You don't use the beta of the company. You use the beta that you have calculated for. The beta of the company that we are given in this question, the equity beta of 1.6 that we are given in this question, or the asset beta of 1.2 we are given, is meant for property development and sales. It's not for cement. Okay, so you cannot use that one. So 5. Then risk premium is 7. So we got this one is 2.38 multiplied by market return is not given in the question. So the difference between market return and the risk premiums, and the risk rate of return is called risk premium. So an examiner has given to us as 7. I repeat, RM represents market return. So the difference between market return and risk-free rate of return represents market risk premium, which is 7% according to this question. Therefore, my cost of equity will then be equal to, let's do it together, 7 multiplied by 2.38 equal, then plus 5 equal 21.66. 21.66%. So that's the cost of equity. Finally, I need to calculate WACC. So 5, calculating WACC, denoted as KW. So WACC is equal to equity value over equity plus debt, cost of equity plus debt value over equity plus debt, cost of debt, then 1 minus tax. All of this multiplied by 100 over 1. So this is the formula for WACC. Therefore, WACC equal to equity value. Examiner has told us that debt is 30%, then equity is 70. So I will just say, instead of me to say 70 over 100, I will just say 0.7. 70 over 100 is the same thing as 0.7 multiplied by a cost of equity of 21.66%. That's what we got in step 4. Then plus debt value is 30%, 30 over 100. Okay, that's 0.3. 0.3 multiplied by cost of debt. The cost of debt is the interest rate. Let's go back to the question to go and identify the cost of debt. Are we given the cost of debt directly? Let's see. We are looking for cost of debt. Now, when you look at the table, when you look at the paragraph after the table, almost the last sentence before the last sentence in the paragraph, you are told that 50% of the total initial outlay of 2 billion naira is to be funded with a loan from federal government development bank at a concessional interest rate of 8%. So that interest rate is your coupon rate, okay, which is your cost of debt, cost of borrowing, payable at the end of year 5. So we have seen the cost of borrowing. So let's go and indicate that. So this one will then be 8%. This 8% must be after tax. And we are told that tax is 25%, then we are considering 75%, 0.75. Therefore, bring out your calculator. Let's do the final number there. So 0.7 multiplied by 21.66. That's 15.16. So KW equal to 15.16% plus the other side 0.3 multiplied by 8 multiplied by 0.75 equal 1.8%. 1.8%. Add the two together. Okay. 1.8 plus 15.16 equal 16.96. Here is 16.96%. Examiner said that your cost of capital should be rounded to the whole number, which is 17% approximately. So I would then say let me see the requirements. Examiner asked us to compute the appropriate cost of capital that Telemundo should use to appraise the cement project, and state why you consider this rate more appropriate than the existing WACC of 11%. Okay. I would then say Telemundo, the appropriate cost of capital that Telemundo PLC should use to appraise the cement project. Is it project or production? Cement projects is approximately 17%. So examiner says you should state why it is more appropriate. This cost of capital is more appropriate than the existing WACC of 11% because it is consistent with the systematic business and financial risk associated with the cement project. That's it. Not too much of a story. You can see this requirement number A is for 12 marks. So you must do your best to earn the entire 12 marks. Any assumptions you have made in the calculation of that cost of capital 17%, we also stated there. Even the examiner is asking you to state any assumption made. So because of time, so I would then say the calculation, or simply say assumptions. So the calculation of the cost of capital above is based on the following assumption. Assumption number 1, we are going to talk about business risk. Talk about business risk. It is assumed that Telemundo PLC and the proxy company both have similar business risk. So, and that's why you are borrowing the beta of the proxy company. We are borrowing the beta of the proxy company. So to calculate your own asset beta, which measures business risk. Then assumption number 2, you can also talk about debt equity proportion. So debt equity ratio or proportion. It is assumed that the debt equity proportion of the proxy and move to the next line of the proxy and Telemundo PLC will not change. However, a debt ratio, however, it is assumed that debt is 40% for proxy and 60%, sorry, 40% for debt is 40 and equity is 60% for the proxy company. Why 30% debt and 70% equity is assumed for Telemundo PLC. That's it. Not too much of story. If there's any other assumption you would have crossed your mind, put it there. So we are done with that. So let's move to the next one because of time. Okay. So number B, you have to compute the net present value and the modified internal rate of return of the project, assuming a cost of capital of 13%, walk to the nearest million naira. Now, before we move to solving NPV and then the modified internal rate of return, do you have any questions so far? Do you have any question on what we have done under the requirement number A? Let me know. Any question for me under requirement number A? Do you have any question? So in the absence of no additional question, then let's solve number B. So I will stop sharing this briefly, or since you have read the question before, and then you have read the question and also you have the material by your side. So let's just go through it together. So we are told in this question that we have to calculate NPV. So I want to calculate NPV. See, on the day of your exam, time is not your friend. So you have to do your best to maximize that little time that you have. Not only that, look for a way to look for a shortcut, if available, for you to be able to do justice so that you can complete that particular requirement in earnest. So in this question, you want to calculate NPV. Since you have read the question A to Z previously, there's no point for you to be reading it again. you know what you want to do. You want to calculate NPV. You already have the format for calculating NPV. All right. You go straight to the question. You know, when you read the question initially, that's why I usually advise that when you are reading the body of the question, underline the variables that you are looking for so that you don't need to be rereading it. Just go there straight and pick the numbers. Now that you want to calculate net present value, what are you supposed to do? Very simple. Go to the question. Do you have selling price? If you have selling price, go there, identify. Once you have the selling price, check again for the question. Are you given inflation rates? If you are given inflation rate, then you need to go and inflate the selling price. Once you inflate the selling price, you multiply with the number of units. Once you get your sales value, then you go and post. Go back to the question again. Are you given variable cost? If you have variable cost, am I given inflation rate for variable cost? If yes, then you inflate your variable cost per unit. You multiply with number of units produced. Then you have your total variable cost. You go and post. You go back to the question. You ask yourself, do you have attributable, specific, direct, or incremental fixed cost? Once you have all of that, you inflate and there's an inflation rate, then you inflate appropriately, then you go and post. These are the things you're supposed to be doing. No need for you to be wasting time at all. On that day, your hand should be dancing, and and doing the right thing. Okay. So with this, I'll need to go back and let us go and identify the selling price together from the question. Because we are working with a format. We have a format already that I've provided last time in our last class. So let's go ahead and calculate our NPV. I would then say number B1, because there are two requirements in that number. There are two requirements in that B. So number B1, calculating net present value. Okay, calculating net present. Our figures are in millions. Okay, so if that is the case, because I don't know the extent of my table, I don't know how long my table will last. So if that is the case, I will not rule yet. I will then go back to the question, what's the useful life of this project? We are given 5 years. Okay, so if that is the case, how am I going to pay my tax? When am I supposed to pay tax? According to the question, we are told that tax rate is 25% for the two companies and is paid in the year profit is made. So what that means is that tax is paid in the current year. Therefore, I will have a column for year 0, year 1, year 2, year 3, year 4, and then year 5. Lastly, I need to create a column for working. Okay? Like I said, I don't know the extent my table will last, so I will just leave it open for now. Or maybe I could just draw a line down there. I don't know. But for now, please, you have to manage my line. I'm not using ruler. I'm using hands to draw. You manage it like that. Okay, then I will come to this other side. All right. So the first item will be sales according to our format. So let's go back to the question and identify the selling price. Immediately after the table where you have the bags of cement, you are told that a bag of cement sells currently for 2,000 naira in the open market. I've seen it. Selling price is 2,000 naira currently. Remember, when I was explaining inflation to you, I told you the last information I told you under inflation, impact of inflation in capital budgeting. I mentioned to you specifically that when cash flow are stated in first year prices, your year 1 prices, inflation should start from year 1. That is, from year 2. That is, once you are given first year price, you should start inflating from year 2. Then number B, I mentioned that when cash flow are stated in today's prices, okay, year zero prices or current value terms, inflation should start from year one, okay? I repeat, when cash flow are stated in today's prices, year zero prices, or current value terms, inflation should start from year one. In this question, examiner has told you that a bag of cement sells currently for 2,000 naira. This is current value terms. That is current value terms. It means that this 2,000 naira is real cash flow. If it is real cash flow, then we are given inflation rate. Therefore, we need to increase it to, we need to inflate it to get the money cash flow. And this 2,000 naira is in current value terms. Therefore, we should start inflating from year one. So I will then go ahead. I will go and do my working. This is for NPV. Then the second page should be for modified internal rate of return. Then the third page should be for my workings. So I will then say workings. So I need the year one, year two, year three, year four, then year five. Number of units. So what's the unit for year one? Please give me the unit for year one. Year one is 500. What about year two units? Bag of cement for year two. What do you have there?
600,000.
600,000. Year three?
650,000.
650. Year four?
800,000.
And then year five.
700,000.
Thank you. So these are the bags of cement that will be produced and sold in the coming years. Therefore, working number one, I want to calculate my sales. To get sales, I need to multiply selling price with the units or bag of cement that will be sold. Before I will multiply the selling price, I need to first of all go ahead and inflate the selling price. Therefore, I will teach you exam method. So I want to inflate my selling price. I will go to the question. What is the selling price is 2,000 naira. Therefore, what's the inflation rate for selling price? We are told that this price is expected to increase at the rate of 5% per annum. So the inflation rate for selling price is 5% per annum. You remember when I was explaining inflation, I said conversion of cash flows. I said how to calculate real cash flow to money cash flow. You remember, in this case, we want to make money cash flow the subject of the formula, which is money cash flow equal to real cash flow multiplied by 1 plus inflation rate raised to power n, because we are compounding it. So it has to be raised to power n. So, and I told you that you don't need this formula for anything when by the time you begin to do your calculation. This is the same thing. This is what I mean by that. So in this case, my real cash flow is 2,000. It's 2,000 naira. Inflation is 5%. Therefore, what I will do is I'll just carry my calculator. 2,000 multiplied by 1.05. Okay. I will say 2,000 multiplied by 1.05 equal, that's 2,100. So I will then come and post 2,100. So 2,100 multiplied by 1.05 equal 2205. 2205. 2205 multiplied by 1.05 equal 2315. 2315. 2315. 2315, whatever you have in your calculator, multiply by 1.05 equal 2431. 2431. What you have in your calculator multiply by 1.05.
2553.
2553. Thank you, Debbie. 2553. That's it. So we have inflated the selling price. You can see I did not consider this formula, but it is implied. You can see this one, I is 5%, so 1.05. You can see I ignore N because I'm just multiplying what I have in my calculator. So the N is already implied in my calculation, in my calculator. This is the method I want to advise you that you should use. I want to encourage you that you should use to inflate. If I don't want to use this method, if I want to break it down, I can say selling price, which is year one is 2,000. Sorry, selling price is 2,000. I will just double, I will put 2,000 all throughout the years. This is a waste of time. I can't be doing this on the day of exam. If I'm the one writing this, I would then say inflation at 5%. So I would then say 1.05 raised to power 1, 1.05 raised to power 2, 1.05 raised to power 3, 1.05 raised to power 4, 1.05 raised to power 5. This is a waste of time. I can't do this. I can't do this. I've gone to the next one. A student is still doing this one. You are still using primary school method. Therefore, I would then say 1.05, 1.05 raised to power 1 equal whatever you have. This is 1.05. Okay, then I will say multiply by 2,000. So this gave me 2,100. Here I have 2,100. I will say again 1.05 raised to power 2 equal 1.1025. As you have it there, multiply by 2,000. This produces 2205. Here is 2205. Let me do one more before I close it. Again, I will say 1.05 raised to power 3 equal multiply by 2,000 equal 2315. Here is 2315. You can complete the remaining work. So I can't be doing this. I've already moved to the next one. You are still doing 1.05 raised to power 4. No, I've moved to the next level. All right. So I can't advise you to be doing this on the day of your exam. It's a waste of time. Use this method and move on. But the second one is more detailed. For a learner, for an average student, yes, you can learn from this. So that you'll be able to see how the numbers are being generated. But again, I advise you to use this method and move on. All right. Now that we have gotten the inflated selling price, so let's say this is A, this is B. Then to get the C is the total sales, and our sales value is in million. I would then say A multiplied by B. So please multiply for me. What do you get? Oh yeah, there's no time. Let me do year 5, 700. Debbie, Prosper, are you there? Multiply by 2,553 equal 1, 8, 1, 1, 0.
50.
Okay, so I've done year 5 for you. 1050. Thank you, Debbie. Prosper, I've not heard your voice today. What's happening? Zainab, you will tell me now you'll be providing number. I've not heard you. Zainab, no problem. Yeah, Debbie, let both of us be doing it together.
1323.
1, 3, 2, 3. Let me do year 4. Year 4, 800,000 multiplied by 24231, 2431 equal 1945. 1945. Yeah, what do you have in year 3, Debbie?
Rounding up 1505.
1505. Thank you. Therefore, we need to go and post. We need to go and post. So I have 1050, 1323. 6 dash 1050, 1323. This is working number 1. Then year 3. Year 3 we have 1505, 1945. 1505, 1945. 1945, then 17, what else? 17 something, 1447 of 1737. Let me see.
1787.
87, 1787. Okay. So I'm done with sales value. I will go back to the question. I will go and check if I have variable cost. Yes, we are told that variable cost is now 800 naira per bag. This will increase at 4% per annum. So we are given variable cost at 800 naira. It is assumed that variable cost is also in current value terms. Okay, so if that is the case, let's go and do our working for variable cost. So I will not clean this one. I will just leave it for your own use so that you'll be able to learn from that as well. We complete for year 5, year 4, and 5. So working number 2, variable cost. So variable cost per unit, we are told is 800 naira at 4%. Inflation rate is 4%. Therefore, I would then say 800 naira, 800 multiplied by 1.04. 832. 832. 832 multiplied by 1.05 equal.
86.
That will be 874.
No.
874. Is it?
No,
Confirm that.
865.
865. Oh, sorry, I used 5%. Error of mind. So the first one, let me do it again.
That
I
one is
have it.
correct.
Pardon?
It's correct. The first one is
Yes,
correct.
1.04. Thank you.
900.
So the next one is, you said this one is 864, right?
865.
865. Okay. Then 900. Okay. Followed by
936.
936. Listen, I've not heard your voice. Okay. All of you will pay dearly.
973.
973. You are the one that will be reading for us now. 973. Anybody that refuse to give me number are the one that will be giving me, that will be reading for us. So that will be the punishment for not contributing. Now, we need to calculate the total variable cost, of course, in million. So say this is C, therefore A times C. So the units, 500,000 multiplied by 832. What do you get? Some of you have gone to watch match. You are watching match. That's why you are not
416.
contributing. You say it's what?
416.
116. Okay,
416.
416. Okay.
519.
Thank you. 519.
585.
585.
749. Rounding up.
Okay. Yeah,
681.
681. Thank you. So let's go and post. I know this one to be 681. I know this one to be 416. This is variable cost. Working number 2. So what about year 2, 3, 4? Variable cost for year 2 is 519,585. 519,585. 519,585. Then
749.
749. Thank you. So let's go back to the question. If you have any relevant fixed cost, let's go and identify relevant fixed cost. Okay. So we're now told again that fixed overhead cost will be 50 million at current prices, but will rise by 8% per annum. Apportion head. So let's first of all treat that one. Fixed overhead cost will be 50 million at current prices and will rise by 8% per annum. So this fixed overhead cost is relevant because examiner told us that fixed overhead cost will be 50, they have not incurred it, so it will be 50 million. So let's go and account for that. So generally, you don't do working for fixed overhead. It's a waste of time. I will just say fixed overhead at inflation rate of 8% in current value terms. Therefore, 50 million, you bring out your calculator to say 50 million multiplied by 1.08 equal, that's 54. This one would be 54. Then 54 multiplied by 1.08. What do you get, Debbie?
58.
58. Thank you. Here is 58. Next.
63.
63. Next.
68.
68. And finally,
73.
73. Thank you. Dash. If you do working for your fixed overhead, no problem. But since it's not affecting, it's not related to units, so there's no point for me to be doing working for that. It's a waste of time. So let's go back to the question. If there are other relevant costs. So we're also told that apportioned head office charges of 25 million naira at a current price will rise by 10% per annum. This is an apportioned head office charges. Anything apportionment is irrelevant. Therefore, you ignore. That 25 million naira is irrelevant. Ignore it. So what other costs? Let's go back to the, yes. If you look at the third paragraph, when you look at the third paragraph of the question before the table, you are told that a total of 20 million naira has been spent on various surveys, market, technical, financial, etc. to date, out of which 10 million naira had been paid. The balance of 10 million naira is due for payment at the end of year 1. So we are told that a total of 20 million naira has been spent on various surveys. So this represents some costs. These are past costs. Remember, when I was explaining to you, I said that some costs are past costs. There are costs that have already been incurred. So they are past costs. Examples include market survey costs, development costs, or feasibility study fee or cost, or research and development. So when you are given such costs in a question, they are past costs. Provided the activity has been completed, they are not relevant. So ignore. So they are not relevant. So at this point, I need to get my taxable profits. Okay, let's determine the taxable profits. Yeah, add it up. Debbie, work with me, please. Zainab, are you still on? I can't hear your voice. Shina, you
Yes,
two,
I am.
you are not giving me number now. You know, the class is slowing down. Prosper,
We
are
are
you
together,
there?
sir. We are together, sir.
We are together, but you are
Sir,
not
for year
talking.
1, 580.
580, okay?
For year 2, 746.
746.
Year 3, 857.
857.
Year 4,
Yep,
1128.
1128.
Year 5, 1033.
1033. Okay. So
Yes,
this
sir.
represents taxable profit. So immediately after, we are following a format. After the profits, the company is supposed to pay tax at 25% because tax rate is 25%. And we are told that tax will be paid in the year profit is earned. Therefore, what's 25% of 580? 25% of 746. Give it to me, please.
Year 5 is 252. Year 1 is 145.
Year one is what?
145. Sorry,
145.
258. 258
25.
year 5.
Okay.
Year 2 is 187.
187.
Year 3 is 214.
214.
Year 4 is 282.
282. Thank you to all of you. All right then. So immediately after the tax, we are supposed to consider tax saved on capital allowance. And you know that the purpose of capital allowance is to reduce tax liability. Therefore, I would then come here tax saved on capital allowance. And I told you when I was explaining the impact of taxation, I said that your tax saved on capital allowance will follow the pattern of your tax liability. Meaning that if your tax liability is in the current year, your tax saved on capital allowance must also be in the current year. If your tax liability is in arrears, then of course your tax saved on capital allowance must also be in arrears. So at this point, let us go and work out our tax saved on capital allowance. So working number 3 now. Let's use here. Number 3, tax saved on capital allowance. So let's go back to the question to see how we are going to claim our capital allowance. In this, yes, in the last paragraph, is that where we have it? No. Where do we have our tax? Capital allowance. Where do we have our capital allowance? Tax rate for 200. Where do we have our capital allowance rates? Let's see, let me. Okay. Okay, let's go to paragraph number 2. In that paragraph number 2, we are not giving, that's no capital allowance, there is no capital allowance rates there. Okay, I've seen it. We are told that in that paragraph number 2, we are told that the sum of 2 billion naira will be required. The sum of 500 million naira will be spent to acquire an existing factory considered suitable for the project. The balance of 1.5 billion naira will be applied for the procurement and installation of essential plant and equipment. Tax allowance can be claimed on plant and equipment at a uniform amount over 5 years with nil scrap value. Okay, over 5 years. So let us go and calculate that. Our capital allowance is for 5 years. In this case, I'm not going to use the formula that I gave to you. We are told that capital allowance is on a straight line basis over the next 5 years. Now, let's go back to that statement. You are told that in that statement that a sum of 2 billion naira will be required for this project. That 2 billion naira is the initial outlay. So we're now told that out of the 2 billion, 500 million will be spent to acquire an existing factory. You don't pay, you can't claim capital allowance on second-hand assets because the original owner of the asset might have been claiming the capital allowance. So the 500 million naira is not suitable for capital allowance purposes. But we are now told that the balance of 1.5 billion will be applied for the procurement and installation of essential plant and equipment. So that 1.5 billion represents the qualifying capital expenditure. So the cost of this asset is 1.5 billion. The useful life of the asset is for the next 5 years. Therefore, 1.5 divided by 5 will give me annual capital allowance. So annual capital allowance is equal to the cost minus scrap value divided by the useful life. Examiner has told us that it's equal to 0. We are told that the useful life is, the scrap value will be nil, okay? Will be nil. So if that is the case, the cost is 1.5 billion. So 1,500 minus 0, then divide by 5 years. So this gives us 300 million per annum, 300 million naira per annum. That's our annual capital allowance. From this, I can then get my tax saved. Annual tax saved will then be equal to the cost, equal to the capital allowance multiplied by company tax rates. Okay, capital allowance multiplied by company tax rate. My capital allowance is 300 million. Tax rate is 25%. Therefore, what's 25% of 300 million?
75.
That's 75 million per annum. Thank you. So let us go and post. Our annual tax saved is 75 million. So remember, you must follow the patterns of your tax liability. It's a claim. This will reduce your tax liability. So it's a claim. You don't put tax saved in brackets because it's a claim. So the next item after tax saved represents scrap value. We are told that scrap value is nil. Okay, so you ignore. Then we have initial outlay. So according to what we have read, initial outlay is 2 billion naira. Dash, dash, dash. Then we also have working capital. We are working with a format. Let's go and check if we have working capital. Anywhere you see working capital, let me know. Working capital, working capital. I think I saw it somewhere. Okay. Working capital. I saw it somewhere. That's from minutes ago. Okay. If you have found this, let me know. If there is no working capital, then we'll move to the next one. Yes, I've found it. In the paragraph, the last statement, in the paragraph after the table, we are told that the project will require a working capital of 10% of annual sales of annual revenue, and this should be available at the beginning of each year. So 10% of annual revenue. So let us go and work out working capital. Working number 4. Working number 4. Working capital. So year 1, year 2, 1, 2, 3, 4, 5, then total. Okay. Now, we are told that working capital is 10% of annual sales. So I would then say working capital at 10% of sales. 10% of sales. So when you look up in our working, we have done sales is 1050 for year 1. 10% of 1050 is 105. 105. 10% of second year sales. Second year sales is 1323. That's 132. 10% of that is 132. Year 3 sales is 1505. 1505. That's a 10% of 1505 is 151. 151. Next item. 1945. 1945.
195.
195. 195. 1787, that's 179. Okay, so this represents our working capital as 10% on sales. Okay, so if that is the case, you can see that our working capital is increasing from 105 to 132, 132 to 151, 151 to 170, 195. Then it starts falling. So I would then say incremental working capital. Remember, I told you there are 2 types of working capital. We have a one-off working capital. There's also an incremental working capital. And we said that if it is incremental working capital, only the increment should be considered and it should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. Therefore, the first working capital is 105. So what's the difference between 105 and 132?
27.
27. Difference between 132 and 151?
19.
19. Difference between 151 and 195?
44.
44. Okay. Difference between 195 and 179?
16.
16.
16. Thank you. Now, this is the implication. You can see that our working capital is increasing from year 1, 105, up to year 4, 195. The highest working capital we have between year 1 and year 5 is 195 million. So, and then in year 5, the working capital reduced to 179. Therefore, when working capital is increasing consistently for some period and at a particular year and it starts falling, it means that the company has recovered part of the working capital. So in this case, the highest working capital for Telemundo is 195 million naira. Therefore, the rule says that the working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. At this point, I would then say relevant year. The one that occur in year 1 should be treated as cash outflow in year 0. Year 0 is the year before year 1. The one that occur in year 2 should be treated as cash outflow in year 1. The one of year 3, cash outflow in year 2. The one of year 4, cash outflow in year 3. The one of year 5, which is 16 million, is a recovery. It's not, the company is not spending that. It's a recovery because our working capital has fallen to 179. That's where you have that 16. That 16 million is a recovery. The company has recovered part of the 195. 60 million has been recovered. Therefore, there's a balance of 179. I would then say 179. So when you had 16 plus 179, it should give you 195. When you had 105 plus 27 plus 19 plus 44, it must also give you 199. Sorry, 195. It means that we have recovered our working capital. This will be for year 4. This will be for year 5. So that's that. At this point, we need to go and post that. 105, 27, 19. Working capital. Please mute. 105, 27, 19. I know this one to be 16, the 179, working over 4. What's year 3? $44. Okay, 44. You can see only one question we're solving since. All right, so at this point, we are using a format. Immediately after your working capital, you're supposed to determine the net cash flow. So I know this one to be 2105. So give me for the rest, net cash flow. Give me for the rest.
$483.
483.
483.
Okay.
Year 2 is 615. 615.
615.
Yes, sir.
Yes, that's what I wrote. 5615. Okay.
674.
674.
$937.
Did you say 937?
Yes, sir.
Yes, sir.
937. Then year 5.
1029.
1029. Thank you to all of you. So at this point, we need to determine the discount factor. Examiner told us that we are to use discount factor of 13%. So here is 1. So what's discount factor of year 1 at 13%? Yes. Discount factor at 13% for year 1. 1.13 raised to power minus 1.
885.
0.885. $1.13 raised to power 5 minus equal 0.543. 0.543. What do you have for year 2?
0.7.
Year 2
Seven
0
eight.
point, 0 point
Zero
what?
point 783.
783 for year 2. Wilson do year 4. Let Debbie do year 3.
Year 4 is 0.613.
613.
Year 3 is 0.693.
693. So let's get the present value, multiply with the net cash flow to get present value.
Year 3 is 467.
467.
Year 5 is
Year 3, not year 2.
467. Year 5
Year,
is what?
year one is
558.75.
55.
8.75.
That's 559. Year 1 is what?
year one is
427.
4288.
Okay.
Now, you don't need to approximate it. It's not up to 5.
It's not up to 5.
Five
Yes.
Let me
is
let me come.
427.455.
Yeah, so
483 multiplied by 0.885 equal. That's 427. Thank you.
Year 4
427.
is 574.
574. Year 3. Year 3.
482. Year 3.
482.
482, yes.
482. So somebody should add up. What's our NPV? So 559 plus 574 plus 467 plus 482 plus 427 equal 2509 minus 2105 404 positive 404. So what's the examiner asking us to do? In that number B, you have to compute NPV. So we are not asked to make a decision at B. So that's that. So I'm done. The NPV is 404 million naira. Then we are number B2. We're asked to calculate modified internal rate of return. So B2, calculating mute, calculating modified internal rate of return. So, and I told you when I was explaining modified internal rate of return that if you are previously asked to calculate net present value, and you are now asked, following that, you are now asked to calculate modified internal rate of return, that you should always use the big for nothing formula. So if that is the case, I would then say modified internal rate of return is calculated as the present value of cash inflow divided by the present value of cash outflow. All of this raised to power 1 over n multiplied by 1 plus r multiplied by all of these ones minus 1. So that will give us the modified internal rate of return. So I need the present value of cash inflow. I would then say modified internal rate of return equal to, we've already calculated the present value of cash inflow, which gave us a 2509. You know, when you add up all the positive present value. That gives us 2509 with less 2105 to get your NPV. Therefore, to get your present value back, just add together the NPV plus cash outflow. That's 2509. Therefore, I would then say 2509 divided by present value of cash outflow is 2105 raised to power 1/5 multiplied by R is the cost of capital of 13%, 1.13. All of this minus 1. We multiply everything by 100%. Therefore, my modified internal rate of return is equal to, bring out your calculator, 1 divided by 5 is 0.2. Therefore, I will say 2509 divided by 2105 equal raised to power 0.2 equal, then multiply by 1.13 equal, all minus 1 equal, multiply by 100% equal to 17%. So the modified internal rate of return is approximately 17%. That's it. That's it. So finally, number B, examiner says we should recommend whether the project should be accepted or not using both NPV and then the modified internal rate of return. So number C, I will say the projects produced a positive net present value of 404 million naira and modified internal rate of return of 17%. I would then say, since the NPV is positive and the modified internal rate of return is greater than the company's cost of capital, is greater than the company's cost of capital of 13%, comma, the project is financially viable and should be considered and should be, what did the examiner use? Did the examiner say consider or undertaking? Recommend whether the project should be accepted, okay, and should be accepted. So that's that. So we are done with the question, but this is not all. You need to state your assumption on how you arrive at your number for the NPV calculation, for the NPV and the modified internal rate of return. Otherwise, you are not going to earn your full mark. You need to state your assumption. So I will then come here and say assumptions. The calculation of the net present value and modified internal rate of return above is based or are based on the following assumptions. Number one, remember what I told you. Whenever you want to state your assumption, you must mention cash flow. We are going to talk about cash flow. Therefore, what's your assumption on cash flow? You state that it is assumed that the cash flow estimates are realistic and will occur at the end of each year. So you can state further that all relevant cash flows have been inflated at the appropriate inflation rates. So that's that. We are done with cash flow. Oh, no space again. Then let me look for space. Number 2, or let me call it Roman figure 2. Roman figure number 2. We can solve an additional question today. So we are going to complete this topic next weekend by the grace, next week by the grace of God. So Roman figure number 2. Again, if in the question you are given cost of capital, you talk about cost of capital. Of course, we are given cost of capital. So we then say cost of capital. So what's your assumption behind cost of capital? You are going to state that it is assumed that the cost of capital of 13%, the cost of capital of 13% given is appropriate and consistent with the risk, with the cash flow, and risk associated with the cash flow and risk associated with the project. Number 3, from our figure number 3, you can talk about inflation. If in the question you are given inflation rate, then you talk about inflation. So you say, it is assumed that the inflation rates will remain constant within the period under consideration. Otherwise, the decision to accept the projects may change, especially if the inflation rates for the cash outflows change or increase. Number 4. We go back to the question. What are the other cash flow? What are the other assumptions that we made? In this question, we also have some costs. So, some costs. According to the question, there are some costs that we ignore. Costs such as we have surveys, 20 million spent on survey, so we ignore it. So why did you ignore it? So let's go and state it there. The 20 million naira, the 20 or the survey cost of 20 million naira is a sunk cost. And therefore irrelevant to the calculation. Number 5, there is another cost that we ignore, which is apportionment. We also have an apportionment cost. So you can talk about apportionment head charges. How much is that? 25 million. So I will come here, apportionment. Charges. So you say the apportioned head office charges of 25 million naira is irrelevant and therefore ignored. This is because this will be incurred irrespective. This will be incurred irrespective of the decision taking on the project. So it's not relevant, we ignore it. If you like, you can also include interest. We are told there are 50, you can talk about interest if you want. You can talk about funding. We are told in the question that 50% of the total initial outlay of 2 billion is to be funded with a loan from a federal government development bank at a concessional fixed interest rate of 8%. So you can talk about that, but again, we have done enough. 5 is okay. So that's it. That's it. So this is end of the question. You can see only one illustration sinks. Of course, I'm taking my time to explain this. Otherwise, by now, I should have completed about 2 illustrations. So that's it. So let me know if you have any question for me, because we can't solve additional question again. It's almost time. All right? It's almost time. So I'll keep the last illustration to the next class. Therefore, I want to encourage you to go and study, to go and read free cash flow, as well as adjusted present value in our next class. So because I will only solve one more illustration because of time, I will solve one more illustration in our next class. And thereafter, then I will go for free cash flow. If we still have time, then I will introduce you to adjusted present value. So, and let me use the remaining minutes that we have to talk about project duration. We can also use this question to solve project duration. Debbie, Prosper, Shina, and all of you, and the rest of you, have we done anything on project duration?
No, sir.
No, sir.
We did not do project duration. I did
Not
not
yet.
explain. Ah, okay. Let me use the remaining minutes to explain project duration then. Okay. So, project duration. Projects duration. I think to make it faster, you can then, when you get your, you can form your notes when you get the video. Now, when you talk about project duration is just like a payback period, but there's a different way of calculating project duration relative to payback period. So project duration represents the weighted average time taken to recoup or recover the amount invested in a project. Okay, let me explain again. Project duration represents the weighted average time taken to recover the amount invested in a project. Company wants to know how long will it take them to recover the amount or to recoup the amount invested in a project. So the project duration is calculated similar to payback period, only that different methods are used. And in addition to that, project duration makes use of present value. That is, the future cash flow, the expected future cash flow that the project will generated will be discounted to the present value equivalent before calculating the duration of the project. Unlike payback period, which of course, the cash flows are not discounted. Therefore, how do you then calculate project duration? There are basically two methods of calculating project duration. Calculating projects duration. So there are basically two methods of calculating project duration. One, you can use present value method. Then two, you can use weighted average method. One interesting thing about the two methods is that whichever method you use, you are going to get the same answer. However, one important thing you need to know is that when you are calculating project duration, if the projects will generate negative cash flow in the first year, if the project will generate negative cash flow in the first year, you are going to ignore the negative cash flow in that first year until the project started generating positive cash flow. I will repeat, if the project generates negative cash flow in the first year, you ignore the negative cash flow, you move to the second year and the rest of the cash flow to calculate your project duration. However, if the project generates negative cash flow during the year, not at the beginning, during the year, it could be in year 2, it could be in year 4, it could be in year 5, provided the negative cash flow is not from the beginning of the year, then that negative cash flow should be included in the calculation of the project duration. So, like I said, if you want to calculate project duration using present value method, so I will say using present value method.
Sorry, sir, I have a question, sir.
Talk to me.
All right, if the project generates a negative cash flow from, let's assume year 1 to year 10, what would then happen?
Project cannot generate negative cash flow now from year 1 to year 10.
Okay, it's not possible. All right.
That is not possible now. That project is not even, the company will not even undertake the project at all. How could a project generate negative from year 1 to year 10? That's a big one now. Now, this is what I'm saying. Say, for example, okay, maybe I will give you the formats next time, but let me just explain this. Say, for example, this is scenario number 1. Okay. Scenario number 1. So this project has, say, for example, 4 years life. In year 1, the project generates a negative cash flow of 5,000. Year 2, cash flow of 8,000. Year 3, cash flow of 10,000. Year 4, cash flow of 4,000. Therefore, when you want to calculate project duration, you are going to ignore the negative cash flow in the first year, meaning that you are going to calculate present value for year 2 or 8,000, present value of this 10,000 naira for year 3, present value of this 4,000 of year 4. So when you are calculating your duration, you can see you ignored the first one. This 5,000 naira should be ignored. Okay, it should be ignored. Now, scenario 2. Say, for example, in the first year, the project will generate 10,000 naira. In year 2, cash flow of 5,000 naira. In year 3, cash flow of 3,000 negative. In year 4, cash flow of 6,000 naira. So in this case, you are going to include all the cash flows should be included. All the cash flows should be included in the calculation of the duration. Of course, when you get to year 3, so whatever the duration of that year 3, whatever number you have in that year 3 will be in brackets. But for year 1, year 2, and year 4 will be positive. So the net amount is what you are going to get. Then, of course, what you are going to use. Then scenario number 3. Say, for example, in the first year, this project generates negative cash flow of 2,000. In year 2, 5,000. In year 4, so in year 3, 10,000. In year 4, negative 500. Okay, what are you going to do? Simple. Because there's a negative cash flow in the first year, therefore you ignore. This should be ignored. You don't include that negative cash flow in year 1. Every other ones. In the second year, the project generates positive cash flow. Third year, positive cash flow. In the fourth year, negative cash flow. Every other ones should be included. So what this simply means is that in any time that a project generates a negative cash flow and you want to calculate project duration, you ignore the negative cash flow in that first year. Any other year that the project generates negative cash flow, other than year 1, it should be ignored, it should be included. So these are the kind of scenario I just printed for you. So, and that's that. So in our next class, I will explain to you, once we are done. Okay, I will briefly explain this to you before we move to the final illustration we are going to have. I will explain how to calculate project duration using present value method and then using weighted average method. So I will demonstrate the two of them for you using the same question that we had under the Telemundo, and you see the result. And this is where we are going to call it a day tonight. And thank you guys for your time and understanding. Before I will bid you bye, let me know if you have any question for me right now. Any question? Do you have any question for me? Let me see. Believe, Abu, you are still on. Prosper,
Yes, no question.
Wilson. Okay. Shina is still on. Zainab, Abdullah. All right then. So in the absence of no further question, and I want to say good night to all of you. I will see you again by the grace of God next week, Wednesday. Thank you guys for your time. Bye-bye.
Thank you too, sir. God bless.
You too. Good night.
Good night, sir.
Good night.